Can you retire early with $4 million in cities like San Diego, where I live, San Francisco, New York, or wherever you really are that you would consider a high cost of living city? And can you maintain a comfortable lifestyle if you decide to retire now for the next 40 years? So in this video, I'm going to go through a real life client case study of a couple who worked in big tech. They knew they really wanted to retire early, but there was a lot of uncertainty if they could really live in this expensive city and make their money last for the next 4 decades or so and continue to maintain their lifestyle and also not get killed in taxes. But before we understood how this would work out for them when they came to me, I first need to understand how that $4 million retirement nest egg was allocated and invested. Because it's one thing having a dollar amount saved, but it really makes a huge difference, especially when you retire early, whether it's pre-tax, Roth, taxable. Also, how is it invested? Is it tied to one specific stock? Is it well diversified? And I know this case study is probably not your exact situation. So if you are looking for a custom strategy, that's exactly what we do here at my firm. So feel free to reach out. But I'm hoping you will find this helpful and really understand what's possible. So let's meet Mark and Jane. Again, both are in their early 50s, and these are not real names, of course, but I want to start with is their balance sheet. That way you can really understand their overall financial picture, what sort of accounts are in place for income, how are they invested before working with us? And I'm using round and general numbers here, but if we break things down by account type, they have a few TOD accounts, so transfer on death, basically just regular taxable brokerage accounts. And these have been funded by a couple years, multiple years of RSUs being paid out, right? They've got $500,000 in an E-Trade account, which is a mix of employer stock. What was also interesting, they have another Vanguard account that's around $400,000, and that's just sitting in a money market account. The good news, it's raising some interest, it's getting some interest here. Jane has a brokerage account at E-Trade as well, again with stocks from RSUs. And they also have a joint brokerage account here at Vanguard, and this one has some more diversified funds. A few current and older 401ks also in the mix, and then also a rollover IRA is kind of one of the last bigger accounts here. And then lastly, they have $200,000 in a high yield savings account in cash. And then the other asset that is factored into this is going to be their home residence, which is around $2 million. Again, this is one of those higher cost of living areas. And there's only one liability they have, which is going to be their mortgage, and it has around $460,000 left on that mortgage. But as far as other income sources go with retirement, there's no pension, there's no rental income. And although they've thought about rental income, they just decided that they didn't really want to become property managers. But the only other income source other than the portfolio is going to be their future Social Security benefit. Now, you can go through paralysis analysis with how to optimize this, but usually when I can, I'm inclined to delay Social Security for as long as possible, especially when it comes to an early retirement. That way we can really maximize the benefit and also negate some of the effects of retiring early has on your Social Security benefits. Because for them, we could probably expect a pretty decent reduction in their benefits given they're retiring in their early 50s. The other thing here is that Jane wants to retire immediately. She's done working, wants to focus more on things that she enjoys, and working in tech is no longer one of those things that she enjoys. So we talked about starting some more philanthropic work, but Mark, on the other hand, is going to retire in about 2 years. Right now, many tech companies are paying out RSUs. He's kind of reaping the rewards of that. So he feels like he wants to work another 2 years or so. But just from this initial look, what this is showing me is that they have the brokerage places, that financial freedom account that is ready to create income and avoid those early withdrawal penalties. But one thing I did notice with Mark and Jane, and when they were thinking about retirement, they thought it meant that building up a ton of cash, living off interest, living on dividends. And while that sounds good in theory, it could lead you down a result that you're not expecting, especially for an early retirement. And this is a phenomenon that I'm noticing with a lot of folks that are addicted to cash lately. And yes, rates are a lot better than they were 3 years ago, but what we know is that inflation tends to double prices every 25 years. So if they retire early and live into their late 90s or 100s, that could mean their costs could potentially double twice. And also we know that historically the stock market has significantly outperformed cash. And I do want to make it clear that you should definitely own cash. I always want my clients to own cash, but you can go too far. While these concerns are understandable and valid to a certain extent, they'll often stem from a misunderstanding of how risk works in the context of retirement investing. So the way we came up with strategy was focusing on something we call the 3 bucket approach. Essentially what we talked about was viewing it in terms of risks in the purpose of each dollar. And this is separate from their emergency fund of cash, which is typically 3 to 6 months of liquid and available cash ready for you if your car breaks down, you have a large medical expense. We want to be able to cover those right away. And the first bucket is going to be around 1 to 2 years of living expenses and something more short term, like you could own things like cash and money market funds. But then you have the second bucket, which is also a little bit more short to medium term money. Now, these investments are still fairly liquid, meaning you can access the funds if needed, but they offer the potential of slightly higher returns compared to cash. And although there's a little bit more volatility with things like bonds, we want to target the more shorter term, higher quality bonds to help with that volatility. And finally, there's the third bucket, and this is huge for them. And for those of you that do want to retire early, and that is having a well-diversified equity portfolio that includes a mix of US stocks, international stocks, small cap stocks, value stocks. That way you can spread out your risk and make sure you don't end up losing to inflation over the long term. Now, when it comes to retirement, the goal isn't just to preserve capital and live on your interests when you retire early. It's to make sure your money can continue to grow so you can buy all the things you want to buy over the next 40 years. But we have a little bit of a problem because some people focus so much on the investment strategy that they forget to marry it to their financial plan. Because even if we can beat the market by 2% every year, or whatever feels good for you as a number there, and you still run out of money, would that be considered a victory? I would say that most people would agree that would not be a victory. So how could they know if they could retire comfortably in a high cost of living area? And what they shared was they want to net about $15,000 per month, which includes their baseline core expenses just to live in California, as well as some of the expenses that will not last forever. For example, we've got their mortgage payment that we're factoring in that'll eventually go away. We have additional travel that they want to do in the beginning, go-go years of retirement, as well as private health insurance prior to Medicare. That could be pretty costly depending on the tax planning you do. But that's over $5,000 of additional spending per month that is not going to last forever. So if this is you, does your plan factor in those changing of expenses throughout your retirement? So what we did was we put it all together to see what this would look like visually and what the numbers would look like if we ran it for the rest of their lives. Now, as you can see here, each one of these bars represents 1 year of their lives, and each bar also represents their total investment portfolio over time. If we look at next year, they'll both be age 52, and their total investable assets are going to be around $4.8 million if we assume some growth and savings as well. And what this chart is essentially doing is it's forecasting your portfolio value over the rest of your lives, accounting things like taxes, inflation, investment returns, as well as their expenses, and then longevity as well. But there are a few assumptions that we use for this projection, especially as it pertains to a higher cost of living area. Number one is running it to age 95 because they feel like they're going to be a little bit older. They have longevity in their family. And you might be saying, no, that's not me. Of course, you can customize that for your own plan. But another assumption is that we are going to also target an inflation rate of a little bit over 3.75%. Again, more conservative considering they live in such a high cost of living area. And lastly, just for planning purposes, we're going to assume that their investments are going to grow at a rate of return of around 6.5% on average when they retire. But looking at this picture, the overall trend was that they are on track to have a pretty comfortable retirement. They could cover their core living expenses, the mortgage, the additional travel, and also health insurance pretty comfortably here. But after going through the process of putting the first initial iteration of the plan together, we knew we wanted to take it one step further, because once they knew their core living expenses were covered, we want to more so test this thing a little bit more to the limits. And that's usually what people miss, is they run a very conservative base case of the plan, or their advisor runs a very base case of the plan. They print it out, stack 100 pieces of paper on your desk and say, hey, don't change, right? That's not reality. So the first thing we did after going through this base iteration of their plan, we wanted to sort of test the limits. Again, not that they have to go with a spending limit, but they wanted to see what was possible. And there's something good about having a plan that you can say, hey, I can spend more. Maybe I do decide to go first class or fly my family out or upgrade our room on one of these vacations. So we wanted to test to see what was possible if, number one, we double their travel to $30,000 per year. We want to see what was possible as well if they decide to give a really large gift of employer stock to their church. Now, one way you can save taxes and help out your favorite charity is by opening what's called a donor advised fund. It's essentially like a charitable checking account. So for them, we just want to test, hey, what would happened if you decide to give a really big gift of $100,000 to your church? Well, what happens is, number one, you avoid any sort of capital gains on the sale of that stock. And also you can reinvest any cash to buy back that stock if you decide to do so. And then you also get a tax deduction for gifting that stock to charity in the year of the gift. And you can see that the plan doesn't look quite as good, obviously, because they're spending a lot more. So looking at this visually, we can see that the gray bars that you're seeing right here is, of course, going to be the loss of portfolio value, but their assets still are pretty robust and lasting until age 95. So looking at their assets, this is still very achievable, and we know that their retirement is already on the right trend here. So getting the big picture of what your retirement plan looks like, factoring in inflation, taxes, spending, investment returns, can give you a lot of confidence to really know if you were on the right track to do this comfortably. But we're not quite done yet, because looking at a forecast like this and projecting things out linearly with constant growth rates, taxes, inflation, and investment returns is really good for putting together a big picture trend of what your retirement might look like. I mean, over the long term, the market could average more than 6.5% for them, but year to year, it could be dramatically different. For example, if you guys remember 2022, the market was down nearly 18%, whereas we had in 2023, the market was up around 20%. Now, that's the important thing you need to know when you're projecting these numbers out, is that we want to get the trend of your retirement, but what happens if you're doing all the spending and the market drops? Will your money last? And that's one of the issues for a lot of people that want to retire early, is coming up with a strategy for withdrawing money and not shortchanging yourselves. It's easy to be really conservative, and you could read online, and there's millions of articles on what people believe a safe withdrawal rate is. The most common one I see is focusing, of course, on the 4% rule. I've seen people also focus on a 3% for early retirement because it's a little bit more conservative, because you're going to live longer. But they're missing something really important. And Michael Kitces, one of the best financial planning researchers, he calls himself a financial planning nerd, performed a great study showing that if you did decide to follow the 4% rule with a 60-40 portfolio, the average result is a tripling of your original principal over 30 years, and that includes inflation adjusted spending along the way. And there was also a 10% chance of ending up with less principal after 30 years, the same amount of time you would finish with over 6 times more. Now, there's obviously a benefit to having a buffer for things like long-term care, any sort of major expenses, but most of the people I work with consider it more of a planned failure if they died with $12 million versus a success. So if we know that the 4% rule is too conservative, what can we do about it? So with Mark and Jay, we want a robust plan that can weather a recession. We can factor in things like longevity, of course, along with their tax situation, which for them, we have to think about not only how much they can withdraw, but how much can they withdraw net of tax to still meet their income need. Because a lot of these traditional retirement withdrawal strategies do not factor in taxes. And then we can also use a model of the portfolio we intentionally built for them, invested for retirement. So this is where the rubber meets the road, and we want to take more of what we call the risk-based guardrails approach. And what we do is establish those upper and lower guardrails when it comes to spending, to basically keep them on track. And from there, we can monitor on a monthly basis to make any sort of necessary adjustments that they may need in retirement. So their portfolio balance is this dotted line right here, $4.1 million, which we set their initial monthly spending here, gross of taxes, around $16,700. And what we do is we monitor this every month to make sure they're staying on track. So for example, if there was a month where their total portfolio, we hit some sort of bear market and they hit the lower guardrail, their income would need to drop to help them avoid taking on too much risk. But also you get the upside of spending more, right? For example, if their portfolio were to grow by 12%, they would be able to have an additional monthly income of around $1,400. But in order to really see how robust this plan is, what we want to do now is stress test it. What would happen if we went through this level of income through some of the worst market periods in history? And the first one that you're looking at on my screen is what would happen if Mark and Jane decided to retire early and the global financial crisis were to happen. They decided to retire in November of 2007. You can see the dark blue is going to be what their actual income would have been during that time period, whereas the blue line is sort of what their planned income, what we planned we wanted to spend. And you're going to see the difference between what actually happened versus what they wanted to spend. So this red line right here is, of course, what happens in March of 2009, where they had to reduce their income by around $900 per month. But then you can see just a short moment later, they can start to increase their income again. And then you have the green lines where they can continue their income back to baseline and then can adjust their income going forward. And then this other chart you're seeing below is their balance in guardrails. It's showing essentially the blue line is their investment account balance, which of course would fluctuate a little bit before 2009. You could see that once February, March of 2009 happens, what happens is they hit that lower guardrail, right? Where the portfolio hit that lower guardrail of around $2.9 million. So that means, hey, there's too much risk. We need to start adjusting their income going forward. And then again, once their portfolio balance hits around $3.2 million in 2014, they get that income bump. So if you put this all together, you have a plan that is much more robust and it factors in longevity, markets going down, and it's a lot more realistic for someone who does want to retire early compared to relying on something like the 4% rule. But we're not quite done yet, because those of you that live in those expensive cities, you're probably pretty familiar with paying a good amount to Uncle Sam. Now for Mark and Jay, we wanted to have multiple different ways to pull money from their accounts to not only make sure that their money lasts, but also help them avoid getting killed in taxes down the road. Because we want to pay what's due to Uncle Sam, but we don't want to leave Uncle Sam a tip. Because unfortunately, without good planning, a lot of people that even are in the position to retire early are on track to pay more tax than they really need to. So when Mark and James came to us, what we did was we ran a long-term tax projection, essentially estimating their lifetime tax bill if they did decide to retire early. And if we took a look at their long-term tax projection, we see that taxes are projected to be very low in those initial early years, because of course we're taking money out of the brokerage account and it's got preferential tax treatment, but they start to ramp up a lot as they begin to age. But this could be a major problem if you follow some of those rules of thumbs, because if we go, hey, let's take taxable, then tax deferred, and then finally from Roth IRA accounts, we have a situation where, yeah, very little tax is generated early on, which can feel like a really good thing early on retirement. But then again, over 60% of the retirement assets are in those tax deferred accounts. And I often talk to people about this. You know, you have a joint bank account with your spouse, but what your tax deferred account is essentially a joint bank account with the IRS. And the IRS is not so patiently waiting to take anywhere from 30 to 40% of their account in taxes due to required minimum distributions. So if we look at the trajectory they were on tax-wise, if they went with their current strategy they were planning to, which means again, taxable, tax deferred, then tax-free, and if they delay their tax deferred accounts as long as possible, they would be in a position where they would be leaving the IRS a tip of nearly $5.4 million. Now, clearly they were very patriotic people, but not that patriotic. They didn't want to be such a major donor to the US government. So we found that if we do some proactive tax planning each year, and we find what I call the Roth conversion sweet spot, we can save a significant amount of taxes along the way. Now, the initial strategy showed them paying essentially $7.9 million. Again, if we follow the current tax law over the next several decades, around $7.9 million, versus going with something like converting up to the 24% bracket via Roth conversions. That would mean about $2.5 million in total lifetime taxes. There's something there, right? There's an opportunity cost. This might be more optimal on paper, but in reality, are they going to do six-figure Roth conversions and pay tons of taxes up front? For some people, it's absolutely. I don't trust the government with all this spending and all this debt, and I don't want taxes to go up in the future, and at least they can control taxes now. But others, we may want to take more of an artistic approach to this, because for those that retire early, this sort of conversion can really compromise any sort of health insurance subsidy that you may have. So we said that, what if we find the Roth conversion sweet spot and just decide to target, how about we go for the 12% bracket based off of running all these different numbers. And this projection doesn't quite save you as much in taxes. I mean, it could be nearly $3 million, but that means you might have more affordable health insurance up front. And then of course we can reevaluate down the road once you reach Medicare. Is there as much of an impact if we decide to do Roth conversions then? So I get this question all the time. Do I optimize for health insurance, or do I optimize for Roth conversions? By finding that Roth conversion sweet spot for yourself, you can be in a way better position where you might have more lifetime net income, which also means leaving more of a net legacy to your heirs. So at the end of all this, Mark and Jane felt a sense of relief knowing that yes, they could retire comfortably in a very high cost of living area. They have a plan for when, not if, markets go down, and they found the Roth conversion sweet spot for them to help them save taxes and also optimize any sort of health insurance. And most importantly, they have peace of mind knowing that they're in a position now where they don't have to stay in this high stress job, and they have the sort of freedom to start planning out that next chapter in their lives. But the problem is that a lot of people do have the wrong idea of how to invest for an early retirement. Some people are on the opposite of the spectrum of Mark and Jane, where they aren't too conservative. They're actually on the opposite end of the spectrum, where they're way too aggressive, and this can create a huge risk for your income when you decide to retire early. So I made a video on how to build your retirement portfolio for early retirement success. You can watch that by clicking right here. Again, this is Matt. I'm a certified financial planner and advisor with 1 Degree Advisors. If you'd like to talk to me or someone on my team about your financial plan, you can click the link in the description, and we'd love to talk with you. Thanks for watching, and I'll catch you guys in the next one.